A record sell-off in the US stock markets has sent European and Asian shares down sharply on Tuesday. Britain's major share index sank to a 13-month low, while the stock market in Frankfurt immediately fell by more than 1% after opening. It comes after the Dow Jones Industrial Average lost more than 1,000 points on Monday. It's the largest ever single-day drop. Investors fear that shares could be seeing the end of the market's record run. Neil Wilson joins us from London, where the FTSE index has fallen to its lowest since 2016. And I think the first question, Neil, why has this happened? Or rather, who caused it?
Well, I mean, we're clearly seeing in Europe it's really a spillover from the US rout that began on Friday and then got even worse yesterday. That's really what's hitting European markets. There's nothing really in Europe, no news from Europe, and that's all down to this expectations of higher interest rates in the US and what that means for equity prices. So we are seeing this recalibration. I think really, we've had 10 years where the, investors have been able to borrow at 0% on pretty much 0% and get a 2% return on the S&P 500 yield. And that's really coming, they're having to rethink that as we get the prospect of higher interest rates and the Fed tightening maybe a little bit more quickly than people had thought before.
In terms of to what extent do the US issues then affect the global markets?
Well, in the interconnected world, it's just simply the case that once you get such a big, significant sell-off like that, it does ripple through to other markets. It's also a factor that what happens in the US in terms of interest rates matters for the rest of the world. So if we see US interest rates increasing, then we're likely to see globally bond yields picking up and interest rates picking up. So it's very much a case of when the US has a sneezes, the rest of the world catches a cold.
That's right. That's been said many times. What kind of a cold could ordinary people have then? People just with a few shares perhaps, but could they see a significant change?
Well, I think we look at the FTSE's off, for example, here. It's off 4% or 5% this week. It's off about 7% from its high. That clearly impacts investors and pension plans, of course. But we're seeing rising yields. So if interest rates pick up, then that makes life easier for the pension managers too. So it's not all bad. It's just simply a case of readjusting maybe the pricing of equities for a different interest rate environment. But that's not a given either. There seems to have been a major reaction to the expectations of higher interest rates, but we've got no confirmation that that's really what's going to happen.
No, sure. So readjusting, you say. So which countries then are going to suffer the most from this dip?
Well, I mean, the US seems, its stock market seems to be suffering the worst at the moment, but economically it's very firm, it's growing very quickly. Europe seems pretty well insulated, although euro strength might crimp some earnings growth and some economic growth. Britain, of course, remains exposed hugely to Brexit, so a sell-off on the FTSE might impact things a bit more here than maybe it does elsewhere. Emerging markets at the minute probably okay in the sense that we have this weak dollar, which is very supportive for those parts of the world. So I think really, it's a case of what's happening in the stock market isn't really reflecting the real economy at the moment. So I wouldn't get too panicky just yet.
Okay, that's the advice from Neil Wilson. Don't panic as yet. Thank you very much.